I'm Taylor Riggs. This is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up, cybersecurity firm CrowdStrike found itself in the middle of the Trump-Ukraine scandal. We hear from CEO George Kurtz in an exclusive interview. Plus, start pedaling. Peloton begins publicly trading on the NASDAQ Thursday. We speak with the CEO after a lackluster opening. And exit stage left. eBay CEO steps down from his role amid turmoil at the global online marketplace. Who will help invigorate the floundering company? We begin with what was a historic week in Washington. On Tuesday, House Speaker Nancy Pelosi formally opened an impeachment inquiry of President Trump. The investigation centers on a phone call President Trump had with the president of Ukraine and whether the president betrayed the nation's security by seeking to enlist a foreign power to tarnish a rival for his own political gain. In this case, the son of former Vice President Joe Biden. While the story was not tech-related per se, an interesting tech company did show up in the partial transcript of President Trump's call with the Ukrainian president. That company, CrowdStrike. I spoke with CrowdStrike CEO George Kurtz about the mention of his company in that presidential phone call.
The only reaction I have is that in 2016, we actually performed the DNC investigation. We worked very closely with the FBI, turned over all the forensic data. And we stand by the conclusions that we had, and they were backed up by the intelligence community. So I think a lot of what we've done has already been said, and after that, I can't necessarily don't understand, where we are with things.
Fold this forward then into broader comments on where you think your company fits into general election security. We are approaching 2020.
Well, election security, I think, is a very important topic if we think about just how electronically connected now we are with voting machines, and we're past the hanging chads of yesteryear hope. So when we think about the ability to protect those systems, it's incredibly important for our democracy, as well as just the integrity of the election itself. So it's a big topic.
And what is your role in working with, let's say, federal agencies like the FBI or with the DNC or the RNC? Where do you see yourself playing a role?
Well, we're certainly nonpartisan, so we help all sides of the aisle and work closely with lots of state, local, and federal government agencies to make sure that they have the best security in place as they go forward.
I could do financial analysis all day long. Yeah. So let's dig into some of the earnings and what we can expect from you. Talk to me, let's just go through the income statement. Talk to me about top line growth. I'm looking here really solid, triple digits, expected to slow maybe a little bit, 40% or so in the coming years. Where do you see sources of future growth?
Well, I think one of the things when you look at CrowdStrike is its ability to cross-sell its modules, and that's a key element of our success. When we started the company, we looked at companies like Salesforce and Workday and ServiceNow and thought there should be the fourth pillar of cloud computing for security, the security cloud. It really hadn't been done before. And part of our success, I think, has been being able to collect data, security telemetry at scale, and then be able to create new modules on top of it and be able to cross-sell that into our customer base. So if you look at our most recent earnings report, we talked about 50% of our customers actually have 4 or more of these modules, and we have 10 of them today. And I think that has really worked out in our favor in terms of being able to go back into our customer base in addition to getting new customers.
And has the shift to the cloud provided a lot of future opportunities?
Absolutely. I think that's one of the areas where we've seen the model that we've created as a true cloud native architecture be embraced, and it's one of the reasons why we've been so successful. In 2011, endpoint security delivered from the cloud wasn't so popular. If you look at 2019 and beyond, it's a core element because it's not just about endpoints and laptops and servers, it's really about protecting workloads, and those workloads could be on-premise or they could be in a cloud like Amazon, it could be in Azure or the Google Cloud, and that's really important. You have to be able to protect these wherever they're at.
When we take a look at the bottom line, not profitable yet, but losses are slowing.
Yes.
What's the pressure right now to be profitable?
Well, I think the way we look at it is, first, what are the unit economics? We have really good unit economics, and there's a greenfield opportunity in the marketplace right now as some of the legacy, I call them fossilized vendors, get acquired, change their business model, try to move to the cloud, which is very difficult for them to do. We think it's a great opportunity to go out and get new customers. We added 730 net new customers last quarter, which is over double from the year before. So as long as we continue to increase the rate of adoption of our technology, we'll continue to invest there. But what's most important is the amount of money we spend on sales and marketing from a unit economics perspective is right where we want it to be. And in fact, it's on the upper end of being very efficient if you look across the SaaS the SaaS companies in general.
There's been a lot of market consolidation. So Nantech, VMware have been bought out. Does the consolidation help or hurt you?
I think it's a net positive for us, and I think it's a natural evolution of this market. If you look at what happened in Salesforce automation, you had Oracle buying Siebel, right? I think the natural comment around that is the fact that it was very hard to make a shift from a perpetual model, a legacy architecture, into something that is cloud-based and truly subscription-based. So a lot of those companies you talked about were having a hard time making this transition both in the cloud architecture as well as their overall revenue model, and they had these mixed perpetual subscription models, which is very difficult.
You IPO'd in June. It has been a tough year for some companies that maybe aren't profitable or valuations feel too high. Any advice you'd give on how to ride the wave?
Well, I think first you have to really start with a great company, and I think the elements of a great company to ride that wave are they have something to do with the cloud. They're SaaS delivered. They've got a subscription revenue model. They have high net retention rates where they keep adding new modules or new bits to their customers, and I think those are elements that really make you successful. I think the market is smart enough to figure out what companies have great earnings potential in the future, and those are the requisite characteristics that we've seen, and we're fortunate enough to fall into that category.
That was CrowdStrike CEO George Kurtz. Coming up, a tough ride for Peloton. The company begins trading at the NASDAQ, opening nearly 7% below its IPO price. We'll hear from CEO John Foley. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Tech IPOs were in the news this week. Peloton debuted on the NASDAQ Thursday, dropping nearly 7% at the open after raising $1.16 billion. Bloomberg's Jason Kelly sat down with Peloton CEO John Foley shortly after its trading debut.
The biggest thing is we're playing the long game. We see this as, literally building millions and millions of subscribers around the globe in the coming years. And now we have the money to do that. We are fully funded after today's primary, so we're feeling confident.
And when you think about sort of the last couple of days and really the last couple of weeks, you mentioned the markets. I mean, WeWork obviously is on everybody's mind. It's a tricky IPO market, to say the least. Do you have a sense of sort of where the miscalculation was, or if there was one?
Yeah, I will tell you, Jason, this is my 8th fundraise for Peloton, and it's always been this funny thing where people either see it or they don't. And so there's believers and there's non-believers. The people that have believed and bet on Peloton and invested in Peloton for every one of the rounds for 8 years now have been very, very, very happy, and we're going to continue to delight the capital partners who invest in us.
You mentioned fully funded. So what are you going to do with some of that money? What does expansion look like at this point?
So we're doing things like building a $50 million television streaming studio here in New York City, another $50 million studio in London, where we'll hire our foreign language instructors. So the German instructors are being hired out of the London studio to stream to our German market, which we open in, I think, 60 days. So we're investing in new content. We're investing in new verticals. We brought the tread to market last year in new markets. We have Canada and the UK and Germany. It's really, we're in investment mode. So someone earlier today was saying, you're losing money. It's like, no, it's semantics. We're investing money, and we feel very good about what we're doing.
And how do you feel about the consumer market? You sell a very high-end product. We are in a bull market. We continue to be, other than some of the volatility that we're experiencing. What do you hear back from your customers, and maybe more importantly, your potential customers about their willingness to, write a big check or charge something pretty big on their credit card? Yeah,
so one of the most important things we think about a Peloton is the optics on affordability. If you have a Peloton bike and you and your live-in partner ride it, it's an insane value vis-a-vis anything else. So we, interestingly, I know, Jason, you kind of wrote the book on fitness, so you know this, but fitness has been a recession-proof category for the last 15 years. More dollars went into fitness in 2008 and 2009 as they did every year. So it's a growth, secular growth over the last 15 years. And we think if we create the best value in fitness, if you ride your bike, on average, our bikes are ridden 12 to 14 times a month. So you divide that by 39, you're paying a couple dollars for a workout. That's obviously, orders of magnitude better than going to the boutique fitness world. And we're going to show over time that's an even better value than going to the gym.
You have described the company in the S1 and in the roadshow as all sorts of things, a technology company, a media company. It obviously does a lot more. Where will you be primarily spending money? Is this a content push that's coming?
Yeah, I would say at our core, we cannot hire software engineers fast enough. So we are a software company, tech company at our core. We've had to learn our way into media. Now we have 13 Emmy Award-winning producers, and we just hired this fantastic new chief content officer in Jen Cotter. So she's going to build one of the most special, media divisions in any category. But at our core, to your question, the investment is going to go into technology. Of course, we're going to open more retail stores and logistics and more markets and all this stuff that starts to show how multifaceted Peloton is. But certainly, software engineering is at our core.
That was Peloton CEO John Foley with Bloomberg's Jason Kelly. And this week brought plenty of turbulence to WeWork. Co-founder Adam Neumann stepped down from his CEO role Tuesday in a move designed to salvage the company's planned IPO. Artie Minson, that's the company's co-president and chief financial officer, and Sebastian Gunningham, its vice chairman, were named co-CEOs. I discussed the executive shakeup with Rhett Wallace of Triton Research and Gene Munster of Loop Ventures.
Well, I think, the writing was clearly on the wall that this was where the momentum was. And so my reaction first is think of this in three chapters. There's the past, and there's things that happened that were very good with WeWork. There were things around the leadership that were not as good. That leadership did a lot of the power that really built the company. Then there's the present, and I have to applaud really everybody involved in just how smooth this is going so far. If you look at the clock on this, it's just a few weeks ago that this really started. They already have some replacements, temporary or permanent, and I think Adam, the way he stepped aside was respectable, and so credit the company for that. That was different than how Uber's leadership changed. It took a lot of time to find a replacement. I think that was what was most surprising to me is kind of the pace that they're going here. And then there's the question about the future. And just to kind of circle back and quickly talk about the timing of this IPO, I think that it is unlikely that anything happens in that October frame because now equity investors are going to want to get want the senior management to have a handle on the business, and that just simply takes time. If I was going to guess, I think it's probably early next year if they want to really maximize the valuation here. They could do something more quickly, but they would equity investors would factor that in with a even lower valuation than what we've talked about. So all in, good move for WeWork, but I think we're still a ways away from an IPO.
Rhett, I too could arguably give you a victory lap. You and I spoke in the last few months after you wrote a smart but scathing report on WeWork about their financials. What changed for you today with the announcement that Neumann steps down?
Well, so what we found ourselves saying about this situation is that WeWork suffered from three things that, when put together, are not good news for a company. The first was significant losses. The second was opacity. They've made it very difficult to analyze the company. And then the third is really arrogance. And I think there are a lot of things we could put in the bucket of arrogance, the related party transactions, the 20 votes per share, and sort of a number of things. And so the only thing that changed today is possibly the third bucket as far as arrogance, but for losses and for opacity, those two problems remain. And I think, what's interesting, having watched this play out over the last couple of weeks, is among our customer group, which is, long, short, and long only investors, a month ago, I wasn't hearing anyone saying, like, Atom is the problem. And even a week ago, I wasn't hearing anyone saying Atom is the problem. So this is sort of a new solution, but I'm not sure it addresses some of the problems that people had most significantly about handing over $3 or $4 billion additional dollars to this company at the type of valuation they were looking for.
Well, and Gene, I fold you back in here as an equity analyst. A corporate governance change doesn't change the top or the bottom line fundamentals, and the fact that this company is losing tons of money. Is that still the biggest concern?
I think no, and I know that isn't consensus thinking. I think that this business is it's a concern if investors don't know that. They understand that this business has a ton of cash needs. And I think the leadership piece is really critical here because it sets the tone for, you just think about all the leaders of these tech companies. It's almost like the company's performance almost is embodied in the leader. And so I think it's really critical. So I don't think that the cash burn is the critical issue for investors. I think they understand that. I think that if you want to think about upside to the story longer term, clearly how they spend their money is going to be important and how they scale this business. But I think this is a little bit more meaningful if they can, really kind of change some of that. I do want to catch myself as well. When I talk about that change at the top, that is a really hard thing to do, to change the culture of a business to be more judicious. And that's why I think it's going to take longer to actually get public, is there's going to be some teething, and the company will probably see some departures around this before I think the rank and file are comfortable.
Right. Well, and Gene, talk to me about the big risk of removing that visionary leader, that big founder. We talked about Elon Musk, who is associated with Tesla, Mark Zuckerberg, associated with Facebook. You talk about Uber and their leadership changes. What's the risk that you remove Newman and the vision goes with it?
It's probably the biggest risk. And that's the catch, in some way, the catch-22 here is that there needed to be some change. But the best ideal, so to answer your question, is it is a material risk. Culture is critical. As an equity analyst, I always focus on income statements and balance sheets. As a private investor, as a venture capitalist, the culture piece is I realize that even with public companies, it's absolutely critical and can't be overstated enough. It's going to be, if I had the hefty responsibility of stepping in some capacity here, that would be my number one concern, is not to lose the vision.
That was Rhett Wallace of Triton Research and Gene Munster of Loop Ventures. Coming up, Amazon focuses on Alexa privacy as it unveils new gadgets in Seattle. We'll have the details of their newest product lineup next. This is Bloomberg. On Wednesday, Amazon introduced the Echo Studio. It's a high-end speaker to rival Sonos devices, the Apple HomePod and Google Home Max. The new device looks similar to the HomePod, making it noticeably larger than any existing Echo. The speaker costs $199 and is now available to pre-order. I caught up with Amazon Senior Vice President of Devices and Service, Dave Limp, to ask him about the changes.
Well, we've really taken a different take on how audio is developed. Basically, we have 5 speakers built into it, 3 mid-range, a front-forward tweeter, and a bass that gives the sense of the music surrounding you, like kind of how the artist wants the music to be portrayed. And we think that's an industry first, and we're looking forward to seeing how customers like it.
You are taking on big rivals, Sonos, Apple, Google. Are you happy with your penetration rate?
We think that this isn't a winner-take-all game, first of all. And you mentioned one of those companies who is a great partner of ours in Sonos. They're really, really great partners, and we think customers want selection. That's always been the case with Amazon. We offer lots of selection and choice, and we want to give that same choice, whether it's Sonos or our products, and we're looking forward to seeing what customers think and whether they like it.
The pricing is interesting to me at a $199 versus the HomePod at a $299. It feels like everyone's really trying to be competitive here on pricing. Are you worried that it's a race to zero?
I don't think so. I think what we try to do is price our products with as much value as we possibly can. We've always had the philosophy since the first day with Kindle to price our products in a way that we want to make money as Amazon and the device and services business when customers use those products, not when they buy them. So if we give them good value and the service behind it is really compelling to the customer, they're going to use it for years and years and years. And we think that the price points we're at now are great.
Dave, I was chuckling a little bit when the headline crossed that said Alexa will now tell when I'm frustrated with her. How will she be able to tell that, and then what does she do?
Yeah, we built a pretty deep machine learning model. It's sort of the advancement of AI to be able to recognize when customers are frustrated. And it's important to realize we're not checking whether you're frustrated with the world around you or detecting that or somebody in your family. We're only detecting when you're frustrated with Alexa herself. And when that happens, we want to try to teach Alexa to kind of auto-correct herself. And the example I showed was a music example. I asked to play one track. She misunderstood. I got frustrated. She corrected herself. And we think that's going to be very valuable on the path as these digital assistants, Alexa specifically, become more conversational over time.
When it comes to privacy controls, what new privacy controls have you added with these new devices?
We did a lot on privacy today. We added new utterances that allow you to ask Alexa, tell me what you heard, so she can clarify that. You can ask Alexa in the coming months, tell me why did you do that? So if she does something that you didn't think was right, you can understand the context of that. And we added a new feature in our Privacy Hub, gives customers the ability to auto-delete their voice utterances on a rolling 3 and 18-month rolling window. And we think customers will like that as well.
Now, in between that rolling 3 or 18-month window, though, confirm for me if there is audio listening, transcribing, recording before I delete those.
We have a different setting, and I think we're the first in the industry to allow customers to opt out of human beings annotating any voice recording that we might have. So you can also turn that off if you want. Some of the personalization of the service and some of the capabilities of the service will get worse if you do that, but if a customer wants to, we want to give them that option. And then we've always had, from the very beginning, the ability for customers to delete any single utterance, any group of utterances, or all utterances with a single click of a button, and those are all also in the Alexa Privacy Hub. So the key for us is to give customers lots of options, and they can balance the level of personalization and capabilities they have versus the level of privacy that they want.
Why, Dave, is it opt-out instead of opt-in?
Well, like I said, a lot of the capabilities that we get from those voice recordings makes the service more important. Let me give you one example. We just launched Hindi in India last week, or maybe 2 weeks ago. And we know that in the first 3 months, as long as we have enough data, that the service is going to get something like 33% better, more accurate on behalf of Hindi-speaking customers. If we didn't have that capability, we didn't have those voice recordings, we couldn't make those improvements. The state-of-the-art of the science wouldn't allow us to do that. So we hope customers will come with us on that journey and be able to have us do that to improve the service. If they don't want, they can opt out and they can delete their utterances and everything will be fine.
And coming up, eBay is just one of the companies to see a CEO step down this week. What changes are in store for the company after the departure of Devin Wenig? And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. It was announced Tuesday that the CEO of eBay is stepping down amid the company's ongoing operating review. Devin Wenig has been under pressure from activist Paul Singer. Singer has been pushing the company to spin off some of its businesses, including StubHub and the Classifieds Group. eBay's chief financial officer, Scott Schenkel, has been appointed as interim CEO. I spoke with Bloomberg Technology's Spencer Soper about the moves.
Part the performance and also just holding the company together, not selling pieces that activist investors want sold. This is bringing eBay a step closer to the scrap heap. It kind of feels like eBay breakup part 2, because if you remember, there's a very similar situation that eBay faced about 5 years ago when activist investor Carl Icahn was pressuring then CEO Steve Donahoe to break up eBay and PayPal. And now we've got further pressure, but this time we don't even have a promising up-and-coming company, that they want to spin off like they did with PayPal. It's more just to break up what's left over.
Yeah, what are the activists pushing for in terms of breaking up the company? How do they think they can unlock value?
Well, there's been pressure to sell their ticket marketplace StubHub, and the classifieds business is more like a local marketplace, similar to like a Craigslist type thing or the startup OfferUp. So they want to further break up the pieces, and Wenig has been resistant to that, arguing that there could be these synergies. For example, StubHub, they were thinking, well, we sell sports memorabilia and band memorabilia, and if somebody's getting a concert ticket or a sporting event ticket on eBay, maybe they'll spill over and buy the T-shirt. But those synergies never really materialized, and it's just been the same story for eBay since even the PayPal split. It's just that there hasn't been much growth. Amazon just leaving it further and further in the dust.
What can interim CEO Scott Schenkel do that the previous CEO was not able to do?
I don't know. I mean, it's hard to find a better champion for eBay than Devin Wenig. He really believed in the company and was really enthusiastic and took efforts to try to rebrand it, kind of shed its image as being this online garage sale and reestablish it as a place to go to buy new things. And none of it just really caught on. It just seemed like inertia has kind of set in. So right now it looks like Scott Schenkel is just kind of a placeholder until they find someone else. And that's going to be more telling. When they pick a new CEO for the company, does it look like they're picking a financial architect to further break it up, which seems most likely, or are they looking for someone to try to re-energize eBay, which was Wenig's plan that just never really went anywhere?
How do they compete with Amazon?
Well, not that greatly. I mean, they've tried to distinguish themselves more. Wenig would even joke at their eBay conferences, like, we're not the place to go if you want a roll of paper towels in an hour. That Amazon's got the commodity play and trying to replenish people's homes and cupboards and things, and eBay being more the place for enthusiasts. Like if you're a car buff, you'll go to eBay to find a hard to find car part, or if you're into video games and accessories, that you might go there to find difficult to find items. They try to differentiate themselves that way. But in terms of delivery, you could be talking days or even week or more to get things delivered sometimes. And those things were difficult hurdles for shoppers to get over. If you're used to getting things 2 days or less, and all of a sudden you go onto eBay, find something you want, you like, and you got to get it in a week, that's a long time.
That was Bloomberg Technology's Spencer Soper. Tuesday also marked a change at the top of Joule Labs as the highly valued private e-cigarette company faces a growing public backlash against vaping. The company announced that Chief Executive Officer Kevin Burns will be stepping down. Former Altria executive Casey Crossway will take over. The Marlboro maker Altria also said Tuesday that it was ending merger talks with fellow tobacco giant Philip Morris. I caught up with Bloomberg's Liana Baker for all the details.
This seems to really be the week for CEOs stepping down. I saw, eBay before, but Joule really, had a lot of regulatory hurdles that I would say that some investors in the company like Altria thought that the previous CEO just didn't handle properly. This is quite a fall from grace. The company had been valued at almost $40 billion when Altria first invested, and who's to say where the valuation is now after states are really cracking down and whole countries like India are banning these vaping products.
Well, and you have a former Altria executive now taking over. What are the plans for this CEO? What can he do with Joule?
Sure. Casey Crosswade is viewed as sort of a safe hand to oversee Joule's transformation. He had been at Altria for many years, and he had actually helped oversee some of the regulatory approvals for IQOS, which is the product that Philip Morris International is now rolling out in the U.S. through Altria. That's viewed as a safer product, at least in the eyes of these companies, compared to vaping. So he has that strength in Washington to, deal with these regulatory issues, but it remains to be seen what changes he can make quickly, because this story just seems to be getting worse.
Well, I'm glad that you brought up Philip Morris, because they also announced that they were ending the merger agreement that they were in with Altria. Am I correct in saying that the merger is off and the CEO is stepping down, that I'm tying those two together?
It's certainly no coincidence, and the sources I spoke to today would agree that while these are companies that maybe are destined to be together at some point, now is just not the time because of all these negative headlines and regulatory headwinds around Joule. When Altria invested, they just didn't know it would get so bad with, 9 deaths connected to this and several federal investigations. So it really isn't a time to announce a $200 billion merger with that much uncertainty.
Well, and as you mentioned, Philip Morris has that IQOS product, and in their announcement today, they said that they're going to now work on getting that into the U.S. and work with FDA regulators here to get that approved. Any sense now of the extra competition that creates for Joule?
It's funny, IQOS has been around a while in terms of how it was in development, and it was supposed to be the hot new thing until vaping came along with Joule. So these companies seem excited to roll it out in the US. Atlanta is already, they're testing it there. But I haven't spoken to anyone who's used it. I certainly haven't used it myself, and I'm curious how, what will people be smoking exactly, because it's, heating the tobacco but not burning it. So it's supposed to be a milder, inhale, but it's hard to say. We'll see how audiences and customers react to it.
That was Bloomberg's Liana Baker. Coming up, more disruption. Atlassian co-founder and co-CEO Mike Cannon-Brookes calls for more progressive-minded solutions to climate change using technology. And Dropbox is dropping details on its revamped services. We'll hear from CEO Drew Houston next. This is Bloomberg. Australian tech entrepreneur Mike Cannon-Brookes is using his platform to fight climate change. The co-founder and co-CEO of enterprise software company Atlassian sat down with Bloomberg's Ed Hammond Tuesday to discuss climate, tech, and why the future needs to be ready for more disruption.
We have a very complicated business sector when it comes to this, right? Because in finance and insurance and lots of other areas, Australia is actually very progressive on this stuff and very worried about climate change and moving forward. Even in the mining sector, I'm incredibly pro-mining. If you look at the opportunities for Australia, right? In a green world, what are we going to make? Panels, batteries, all these sort of things. What do we make? Rare earth minerals, lithium, nickel, copper. We have just a phenomenal amount of opportunities before you get to sun and wind in mining. That doesn't mean that the fossil fuel parts of mining that are incompatible with a future climate, we don't have to transition out of and put together plans to transition out of.
I just want to pick on this. You talked about batteries. Obviously, you famously had this bet that you lost with Elon Musk a couple of years ago, where he said he could build a battery of a certain size in 100 days. You said he couldn't, and he did. He's obviously a sort of standard bearer of sorts for this push to be more green and more environmentally friendly for the long term. And is representative of a lot of sort of people in the tech industry who are making these claims about where we should be heading. Is there a problem that people like Mr. Musk are sort of so aloof and kind of otherworldly that perhaps it's hard for the average person to relate to them and say, this is something we should be on board with?
Sure. Look, I think in Australia we have some phenomenal examples of, again, where there should be an opportunity. So absolutely agree, it can be hard to connect to Elon. He's an awesome character, but he's not your regular guy. Nor should he be. He's amazing for humanity, right? But you have to have both regular connectivity and all sorts of parts of society. Australia, we have some really interesting examples of this, right? So we have the highest penetration of household solar in the world. More people sleep per capita under a solar panel in Australia than anywhere else, right? So that's an army. That's a movement that can be moved. If you're sleeping under a solar panel, you understand this. And when it comes to batteries, it's even more crazy. We have more batteries in Australia, full stop, residentially, than anywhere else in the world, right? Than the rest of the world put together. More residential batteries, right? So we have this engaged population that understand these issues already in Australia. We've just got to get that aligned with with stable government policy.
Another area where you've been very strong with the government is saying that they need to do much more to position the country and the business sector, particularly for the sort of the wave of technology that is going to come and disrupt not just tech and retail and some of the more sort of obvious industries, but in your mind, every industry eventually is going to be a tech industry. Are they doing enough?
Look, we're working really well with the government on this area and trying to push forward. Obviously, we need again, sensible policy, sensible settings on technology and technological issues, and these are complex topics of encryption and violent material and all sorts of other things, but we still need to be very engaged and to move that stuff forward so that it's a sensible place. And secondly, we need to have a viable both tech industry and tech-enabled every other industry in Australia, right? A simple stat I'd like to give is we're 1% of the world's GDP. If we're not 1% of the world's technology production, then we're going to be in trouble as an economy, right? As the economy moves more towards technology as a broad, it's the biggest industry in the world already. It's only getting bigger. We have to be producing some technology in Australia. It doesn't have to be all of it, but you'd argue we have to produce 1% of the world's technology to be 1% of the world's GDP. And we need to, keep moving the economy forward such that that's the case, and that's education, it's immigration, it's sensible policy settings in all types of areas. Well,
immigration, interesting you should mention, because immigration obviously is a huge part of what allows some countries to be more successful at technology than others, because the tech workforce, as we know, is entirely transient and will go where they feel the best opportunities are, the most interesting companies are. So what does a country like Australia have to do to attract that workforce to such an extent that it can be at that 1% level or higher for producing tech GDP? Yeah,
I mean, I think we're doing a relatively good job recently. We've had some big changes in the last couple of years on immigration as it relates to the tech industry, which is actually in pretty good spot. Can always be a bit better, but to be fair, over the last couple of years, it's in a really good spot. I think most of the policy settings are pretty sane around, you must invest in education and local, and the way that we think about it at Atlassian is very simple, is that we need to invest in the talent coming up from the bottom, right? So high school and then tertiary education. We need to have lots of graduates. We have lots of talent in Australia, that's not the problem. What we don't have is lots of experience. So the higher up the company you get, the more we don't have a lot of people in Australia with 10 years worth of technology experience. So we have to import those, and then we make sure internally that when we import, say, half of a level or an area, the half that we import are helping the other half and all of the graduates and everyone else to up level. And that's how we grow the economy. Hopefully that talent stays in Australia. It's a great lifestyle, it's a great place to live. There's a lot of sensible jobs. The economy is obviously doing pretty well if you look over a sort of 3 decades period. So, we're hopeful if we can get that sort of talented individual into the country, they'll stay and long-term contribute to the economy.
That was Atlassian co-CEO Mike Cannon-Brookes speaking with Bloomberg's Ed Hammond. And coming up, Dropbox is dropping details on its revamped services. We'll hear from CEO Drew Houston next. This is Bloomberg.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Bill and I always look for any philanthropy we do to fill some of those gaps.
I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech.
I think Facebook's how we won in a lot of ways.
Do you ever take any of the tips and give them to your LA Clippers coach?
No!
I will stand up for Canadian interests. I will only sign a deal that is good for Canada.
Coming up on Bloomberg West, the stories that shape the week in business around the world.
Welcome to Bloomberg Big Decision. Really good to have you here.
Thank you so much for having me today. We know this business inside and out.
You've really built a conglomerate.
We saw amazing opportunities in the Middle East.
They had the dream. You had to bring it to reality.
Between the three of us, we can really do anything.
I feel like this is where we should go.
Dropbox is going way beyond file sharing. The San Francisco-based company announced new services Wednesday, including a new desktop app, which functions as a digital hub where workers can collaborate with colleagues on projects that require access to digital files. We found out all about Dropbox Spaces with the Dropbox CEO, Drew Houston.
So we announced Dropbox Spaces, which is one of the biggest changes we've ever made at Dropbox. And it's our first step towards building what we call the smart workspace, which is a calmer and more focused working environment, and changes the Dropbox experience from being a folder full of files to an intelligent, collaborative team workspace for all your cloud content. Because we watch as our customers are using Office, they're using G Suite and Slack and Zoom. Dropbox is becoming this new kind of app that brings all these other apps together and cuts down on the noise and makes it a smarter and calmer experience.
Talk to me here about how you're building on current customers, or if you want Dropbox Spaces to be new customers.
Well, we've built our entire business on collaborating on files. But with the smart workspace, we're going beyond that on a bunch of dimensions. So first is supporting every kind of cloud content so that you can still have your PowerPoints and PDFs in Dropbox, but then you can also have Google Docs and Dropbox Paper Docs and Airtables and whatever you're using all in one place. And then second is it's a much more engaging experience. So in addition to the content, you can see all the conversations around it and all the context around it. And you can send someone a Slack message from Dropbox, or see your calendar, or start a Zoom meeting. And we found that a lot of our customers are struggling to piece all this together, having to switch between a bunch of different apps. And so we see an opportunity to organize your working life across all these different tools while still maintaining the choice to use what you want to use.
Talk to me about top-line revenue growth. When we dig into your financials, very strong double-digit top-line growth. Some analysts, though, at least on the average consensus on the Bloomberg terminal, looking like it could slow to in the mid-teens. What are you doing to maintain that top-line revenue growth?
Well, first, we start with a huge opportunity. And in many ways, Dropbox Spaces expands on our opportunity because certainly many companies or many teams need to collaborate around files, but every team needs to collaborate around content. And so we start with solving a problem that every person in every company has. And then with the new Dropbox and with Spaces, we're evolving the experience. And now we have a new generation of our product. It does a lot more for our users than we have in the past. And now our focus turns to driving adoption, getting in people's hands.
And analysts are actually really starting to forecast what could be your first annual profit in 2019. Are you on track to reach those goals?
Well, I mean, it's a testament we've got a really efficient and scalable business. And balancing growth and profitability has always been important to us. And we've, in many ways, applied the consumer internet playbook to business software. So we've got this really efficient self-serve motion where people spread the product for free. And that's how we've been able to reach, that's how we've been able to grow the business. And it's worked really well.
There's been a lot of scrutiny recently on unprofitable companies. You've been public for about 18 months or so. What's been the biggest challenge?
I mean, it's been pretty straightforward for us. And in many ways, we laid the tracks for being a public company years before we ever filed for an IPO. And so the biggest challenge is actually something that I think is healthy for us, which is it's like being drafted into the majors. There's a big scoreboard. You know, we got to perform. Creates a big sense of urgency. And on the one hand, there might be parts of that which are challenging, but I think in a lot of ways it builds a healthy discipline and rigor into what you do. It creates a lot of urgency.
That was Dropbox CEO Drew Houston. And one of Dropbox partners, Vimeo, made their own announcement this week. On Monday, the video sharing company unveiled a new tool that lets businesses, brands, and agencies find and hire world-class video professionals to create content. Bloomberg's Ed Hammond sat down with Vimeo CEO Joule Sood.
This really isn't a new offering. It's just another way for us to lower those barriers for businesses and make it easier. And look, we don't think of ourselves as a marketplace business. We are a software as a service or SaaS business, but we have this wonderful community, this creative community at scale. And so the ways that we can leverage it to add more value to our users, we think is a differentiator.
You're a SaaS business, but you're also a premium content business because it is behind a paywall. There's not the sort of, you can't access it for free. But on this, I noticed you said in the release today that you're not going to be taking a cut. There's going to be no commission that Vimeo takes. So how do you monetize this piece of the business?
Yeah, so this is not really a separate revenue line for us. The reason that we're doing it is to increase engagement and retention on the platform. And like any good SaaS business, we're interested in building long-term value and relationships with our customers. The vast majority of Vimeo's revenue is annual subscription plans. And so for us, this is actually just about the more people that are coming to the platform to make video, the more value they're finding, the more that they'll engage with our tools and the longer that will stay, and that's good for our revenue line.
And does it give more power to the sort of the businesses who are using the site to actually access content, because they can now come and say, well, look, this is the kind of video we want, or this is almost the commission that we want to put out there, and then the creators can come to them and say, all right, well, we're well equipped to provide this because of X, Y, and Z reasons.
Yeah, I mean, what we see is that if you're a business or a brand or an agency or an entrepreneur startup, you need to make more video every day, right? You're making video for social media now. Your audience expects higher quality, almost Netflix-style quality content. And so the barriers for you, the demand is there, but it's really hard. It's hard to figure out who you can work with, find someone on your budget. In many cases, businesses, they're not thinking about video. They're thinking about growing their business. And so this is really about lowering those barriers. And what we found is that there's a high demand for this from both sides of the community.
Now, it's impossible to talk about Vimeo without looking at where you guys are headed in terms of potentially becoming a standalone public company. Obviously, IAC has a long successful track record of doing that. And now Vimeo is one of the two companies under the IAC umbrella that has its own results broken out, you guys in Dotdash, I think, more recently. Talk to us about the path to IPO and where you are headed on that.
Yeah, so look, IAC has said this, and it really is true. For Vimeo, IPO isn't a business strategy. It's a funding vehicle. And right now with IAC, we have we have a well-funded long-term shareholder. And our focus is really genuinely not about IPO. It's about capitalizing on this massive market, $20 billion market for serving the people behind the camera and not investing in content like so many others are doing, but investing in the businesses and the creators that are making that content.
That was Bloomberg's Ed Hammond. He sat down with Vimeo CEO Joule Sood. And that does it for this edition of the Best of Bloomberg Technology, where we bring you all the latest in tech throughout the week. And tune in each day, 5 p.m. in New York, 2 p.m. in San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.